Greetings, Dr. Jeffrey Scott. This is my weekend market update for Christmas Day, 12/25/2022. First, I'd like to wish everybody a Merry Christmas, Happy Hanukkah. I hope you're safe and warm wherever you are, and I hope you're not traveling into some of these cities where the airports have had cancellations of thousands of flights. I'm sitting here in my office in Santa Fe, home office, so there's always a little bit of echo here, but it's so beautiful here, especially in the mornings. Yes, that's me in the lower left-hand corner. Some people had asked me, do you have any recent pictures? And that was me presenting at a healthcare conference, a value-based healthcare conference in October, so it's actually a pretty recent picture. Welcome all remarks on YouTube. You can also email me at hgsidoc@gmail.com. I have nothing to sell you today, so this is purely about my views on the market. I use a lot of different programs, and I thought I'd actually expand a little bit to show you some of the things that I find most useful on some of the different tools that I use. So let's kick it off and take a look. Now, I titled it, Will Santa Bring a Rally Off of Support? We're in an interesting time in this market. Anybody that listens to me on a regular basis knows that, one, I'm not a perma bear. If anything, I was way too bullish at the bottom in 2020. It played out okay, but that was a weird market. But I have been pretty bearish for months, if not the entire year 2022, and really have much smaller positions in the market. I take a lot of money out. Sometimes life works in ways where you need the cash elsewhere, whether it's buying a house, a new house, or other uses of your cash, paying taxes on your gains. So it's been an interesting year, and I've been very bearish and pounding the table on cash and being careful. Disclaimer, this is for education only. Anything I recommend is in the spirit of education and not investment advice. I'm a doctor, not a broker. I am independent. The tools that I use, I've paid for, even wealth charts. For example, trading involves risk. You are solely responsible for any investment decisions that you make. Speaking of wealth charts, Wealth 365, which I guess is sort of a sister organization, has, I believe, 4 summits during the year, Wealth 365 summits. They're awesome. That's how I first got associated with wealth charts as a user, bought a bunch of tools. And the first one will be in January. So the only time of the year that I really sell something to date, which subject to change obviously, is during those quarterly events. And some of my tools are already included for free in wealth charts. Much of what I use is already in HGSI, but it's the scanner in wealth charts that really makes a difference. So I really welcome you to attend, and I'll put this link as clickable under the video. I always like to start with the indexes. So the first thing is when we look at the last 5 days, so the week we just finished, there's a lot of green here. But when you look closely at that green, it's things like the VIX, it's silver and gold. Yes, the Dow was up 0.9% over the last 5 days. Commodities up 3.2, oil up 6.8, Bitcoin up 5. So it wasn't a strong week for equities. In fact, if you look at, besides the Dow, the S&P was flat, down a teeny bit. But you look at the Russell, also flat, and then the NASDAQ down in the 2% or more range. So not a great day, a great week for growth. Friday, you can see here, is mostly green, and the dollar continues to be weak, although it was flat on Friday. And then what's really leading to the downside, and what is now down 68.9 off of its 52-week high, but my goodness, I'm going to have to start looking at all-time highs because we've now lapped the year. So ARC was even higher before that, but down 69% in the last year. Now over here, you've got how much these indexes have bounced from the October bottoms. And you could see we've still in healthy territory, especially on the Dow and the NYSE and the spiders. The NASDAQ, which is more technology laden, biotech, not a lot of energy, certainly is lagging behind. So a lot of the move that we've seen since those October lows, we've given back. If you look at price change from the beginning of the year, what's up? The dollar's up 9% leading, and commodities are up 23%, really driven so much by oil. If you look at what's up from the beginning of the year, it's XLE energy, and it's off 8% off its highs. The losers, communication, discretionary, technology, and real estate. So I like looking at certain things underneath. One of the things I like to look at are the long-term rates. So the 10-year and the 30-year have both turned up some. I think part of this recent strength in the market clearly has been the fall in the long-term rates. Picking up, does that mean anything? I don't know. Does it mean people think we're less likely to go into a recession? You would think that would be a positive thing. Or do they think the rates are going to go much, much, much higher because of inflation, which would be a negative thing? Now, falling rates that were in the setting of Fed tightening, a recent tightening, Fed's not stopping tightening anytime soon that we're aware of, were concerning because somebody was saying the economy was probably weaker and a recession was more likely. Is a recession in our near future? Well, I look at two charts, and these charts to me are very important. First one is the 2-10 yield curve. Some people like the 3-10 yield curve. When we break below, you typically get the recession after you recover and take out the zero line on the yield curve inversion. I used to show a chart going back to the 80s, and every time you broke below, you saw a recession. Now, recessions don't have to be like 2008 and 9, when I remember being on a treadmill watching the markets after dinner and watching them show money markets. Your dollar you put in was starting to be worth less than $1. I don't think we have that kind of recession on our cards, but a recession is probably going to happen. And then the other thing here that is, something that can signify or lead to further market falls is when you start to see the spread get tighter, which sort of reflects how hard it is to get money. And in 2018, it rose at the end of the year and the market rolled over. And we've been at those levels now for months. This is what happened in 2020. So two reasons that make me worry about the economy going forward. And obviously, there's hundreds more we could come up with. Now, on the week, stocks above the 200-day moving average turned up. Stocks above the 40 really didn't do much. The really short-term 13-week new high, new low actually turned up and is very neutral right now. The buckets, this is where we were a week ago. At least I guess 19th was Monday at the close. I think over the weekend I talked about how many stocks were below their midline and how we're starting to see stocks congregate below their Bollinger Bands, and that typically is a sign of an impending reversal. This is what Monday looked like, and you could see those have gone away, and now 26 versus 9 are above their midline. So we did have a recovery as we anticipated. Doesn't mean new highs, but a short-term recovery. Hindenburg omens, at least in edge rate, and I'm using here the NYSE Common and the NASDAQ, we don't see any evidence of a new Hindi. But we do see a lot of new lows. In fact, near double-digit new lows on the NASDAQ, less high, but still new lows and no new highs on the NYSE, telling me this market is far from healthy. Now, it's interesting because if you look from Saturday to Saturday, so what did this week do? I've got a funny curve here. Now, I probably have to eliminate this part and this part, and the reason for that is because the number of stocks gets pretty small. But if you look here, clearly the higher the ERG, the better you did. ERG representing EPS rank, relative strength rank, and group rank. Now, reality is it's not a symmetric thing here because with the elimination of the peak and the valley at the beginning and the end, no group was over 5%, and I've got groups that were between 5 to 10% on the downside. If you look at performance tied to EPS rank, yeah, if you had earnings, you didn't do as bad. If you look at performance related to relative strength, interestingly, some of the stocks that had no relative strength, of which there are very few, actually outperformed. And then this is interesting, stocks that led and lagged, and not the stocks in the middle, the prior week, actually had better performance. I think this was a week that we did see a bounce. It was modest at best, and certainly not in technology, although it did get better from Monday. Looking at some of my favorite pieces of the Q tools, real-time buckets, and what you saw during the day on Monday is we're getting in the 50% range. So I knew, and Sager knew because he watches it, and everybody, others that do as well, that we were going to get a shift to the right, meaning a reversal to the upside. Again, it didn't have to be a big reversal. Sector performance on Friday, look at that. The only thing that wasn't up was healthcare. And when we look over the Friday, you had 91% of sectors up, 85% of industries, and 76% of stocks. So incredibly strong day going into Santa Claus weekend. Now, when I look back over a 5-day period of time, it was a strong week here. You could see more wins than loses, 50-50 on industries. But when you look back at 2 weeks and a month, it's been a tough market. Do I think it's time to celebrate and signal all clear and time to go all in the market? Absolutely not. I think that there was a lot of forces working on the market over this past week, and there was some relief on Friday plus some good holiday cheer, and you wouldn't expect the volume to have been significant. Speaking of volume, over the next couple of weeks, let me just answer this text. Over the next week, per se, volume is going to be quite low, and low volume can lead to lots of volatility that disappears once the real traders come back. Know your news and earnings, quiet week. We do have some jobless claims in the PMI. Remember, the first week of January, we're probably going to be looking at monthly unemployment. There is no Fed meeting in January. The next one is in February. Not much in the way of earnings. One of the recent strong stocks, Cal-Maine Foods, has earnings on Wednesday. What a weird time to have earnings. So there's nothing new here that I haven't said already. Modest gains on Friday. Dow was up less than 1%. The Qs were down a lot on the week. Commodities led, oil, commodity index. Small caps suck. They're weak. IBD 50 ETF was down a bit, but look at it on its year. ARKK down 6.9 on the week. Again, as I mentioned, low volume this week. Should be interesting to see if we have any follow through to Friday's rally. On weekly charts, the major indices look poised for more downside. Shorter term charts, there is near term support, and I'll show you that in a second. I am expecting a market to maybe sneak a little higher into the year end, but I have very little conviction. I think we're going to retest the October lows in Q1 until the Fed takes their foot off the pedal of raising rates. I do these things for reasons that sometimes escape me. I've been doing these videos for 20 years, and I think I keep doing them because I'm afraid to stop. I do the same analysis every night for myself, so really on the weekends, except for this PowerPoint, I'm just showing you the things that I do on my own. I've met a lot of great friends through these. My live meetings have always been a lot of fun for me. This has been a really weird year in the market. Sentiment has been so horrible across the board. Hopefully by this time next year, we'll feel a little bit more bullish, and my whole family wishes you happy holidays. I showed this last week, and I just want to remind you of this. Markets don't bottom. These are the bottoms in the blue lines until the Fed cuts rates. Okay, whether we're looking in the 80s, whether we're looking in late 80s, early 90s, 2003, 2009, all of these bottoms occurred after the Fed started cutting rates. We're not close to cutting rates here. The other thing here is this black dot right here represents where we are in the current bear market. at least where we were a week ago. This square here is the average bear market occurring during a recession. Okay. If you're a secular bear, if you're a cyclical bear within a secular bear, this is the average. So you look at where we are today, which is right about the mean for a cyclical bear within a secular bull. If we go into a bear market, a recession rather, we're probably looking potentially all the way to this black box. That's another 10% or more down. So I just point that out because at the end of the day, the old axiom, don't fight the Fed, is real. Again, hope to see you at the summit. If you've not been there before, Wealth Charts is a wonderful platform. It's one of the platforms that we'll use today. It is offered at its best price during the summits. Rob Hoffman does a lot of speaking during the summit, a lot of education, and he brings in 40 to 50 other folks, some that are selling, well, the majority have things to sell you. Often they have tools inside Wealth Charts, so I highly recommend the Wealth 365. And this is the sunshine of my life, guys, girl. This is my little granddaughter, Molly, and she's telling you it's time to kiss 22 goodbye. Let's go on to the charts, and hopefully we'll see you in Florida next year at my next live meeting. So let me get out of this. Sometimes I got to be careful. I don't want to. There you go. All right. Took that off. Now I can close this. Awesome. So I'm just going to start with one of the views I have in TradeStation. This is daily charts. Let's just switch to the ETFs because they're going to show the same story. Of the spider, the Qs, the diamonds, and the Russell. Now, there's a lot of things on the chart, and I think I want you to ignore most of them. Let me point out what matters. On the daily chart of the market ETFs, we are sitting here on these two lines, which come from Sager's Q tools, sort of the outer boundary, and they typically act as support on the downside and resistance on the upside. These arrows are John Person buy signals. This is called a headwind, which shows after you move too much, too fast in one direction. So if you look at the daily ETFs, you see that we are pulled into support. We've got multiple new buy signals. We got headwinds. We got stretches, which is another oversold type indicator. And that tells me we're going to bounce. So that makes it difficult for me short term to be putting on more short positions. Now, here's the problem that we have. Let's look at the weekly charts. We're right up against resistance. Up here, if you look at the weekly charts, either hitting trend line resistance, up to the boundary with a sell signal, a stretch, or at resistance with sell and stretches. On the weekly charts, these all look like we're going down. So short term, maybe we got a little bit of upside, but I think as we go into the new year, we're going to be going down further. Now, there's certain things about HCSI that nobody does better. And pretty much each day I do the same quick analysis in HGSI. So I like to look at the markets in both wealth charts and HGSI. So in HGSI, I have a warehouse view, you all have, it's called T1, top-down analysis, force and bongo score. And this is going to rank the indices, and if you just open up what they're being ranked by. So if you think about HGSI, a view is a combination of a filter. Actually, let me open this up here. Of a filter and a combo ranking. So the filter isn't going to do a whole lot here. It's just making sure your last close was over 5. But what's really driving the ranking is this combo ranker. And what the combo ranker is looking at is 1-day price change, 5-day price change, 13-day force, and then accumulation, distribution. So if we look at that, we're looking really short-term momentum, is the way I like to think of T1. And what led over on Friday? Gas, short treasuries, silver, oil, commodities, then the Dow. That's not what you want to see if you're an equity investor. What lagged? The NASDAQ, ARC Innovation, FANG, ARC Genomics, Semiconductors, NASDAQ 100. Also, not what you want to see if you're an equity investor. But perhaps the thing, I don't know why I keep losing what I want to show you, that worries me the most, and this is the NASDAQ, is that I can take any of these indices, but specifically the spiders and the NASDAQ. And I could go to the highs, find where the highs were, so it's in this area, and then I could connect down to here. And I've got what was resistance here, what was resistance here, here, and we didn't quite get to it here. So we've got pretty strong trend line resistance, similar to, go back here to the daily, what we see right here. All right. So until we break and stay above that line of resistance, I think we're going to find this market is tough. Now, the spiders, whoops, that's not what I wanted to do. Sorry about that. Just open the spiders up again. You can do the exact same thing on the S&P. And again, why would anybody expect the market's going to do well until we break out of that trend line resistance? So that worries me about the market. So I like to look at the markets here. And then sometimes I talk about the Eureka and the Phoenix. I've only got those programmed really into, well, I didn't program them, they're EANs into HGSI. And you could see here, interestingly, on Wednesday, we actually threw a Eureka. Wednesday was a very powerful day, but it ran right into that 50-day moving average and didn't do much. Now that Eureka is on the NYSE. There was no Eureka on the NASDAQ. Those are some indexes that I look for finding reverses in the market. Other thing that I really like HGSI for is on the industries. It breaks the market into 174 industry. There's about, right now, about 1,200 different instruments, of which, unfortunately, the entire market has been poisoned by so many SPACs. So there's probably 1,000 SPACs, which you can probably tell I'm not a fan of. If you look at, so you got 174. If you look at 2-day force, this was a big change over the last week. We got 57 short-term momentum up versus only 9 short-term momentum down. Now, if you look at these, healthcare has been super strong, but look at this: biotech, specialty, life sciences, medical devices, equipment, internet media, healthcare supplies, home builders, healthcare facilities. Now, this may have been a 1 or 2-day thing where the markets are trying to digest some recent gains, but because you could see here, you can't see really well, but biotech has been moving up, but it had a really rough, you could see 1-day change, and you could see on many of these were up over 5 days. But this bigger number here on the 2-day up is different. And what I like about HGSI from a top-down perspective is if I highlight the industry group, and I've ranked them by raw, and I right-click on it, and then I left-click change to industry group, stocks pop up. And I like to go through the top 10 groups. Let's make this a little bit easier. And look at the top 10 groups, and then, those that use my dots in TradeStation, TradeView, wealth charts and others, they're sort of broken out as individual lines here. This is Occidental Petroleum. I actually put this on my watch list. Why? I think energy is going to lead right now. We're going into a strong part of the year, at least into February for energy. And it's sitting right at some major market moving averages, and a break above this will be interesting. The other reason, look at the earnings per share growth, at least going into the next quarter, 30% on a multiple of 6.95. The next one on the list was ConocoPhillips, which I think more of as an integrated, but I guess it's not. And why do I like it? Because remember those trend lines we were drawing that were resistance? We can also draw them, and you can draw them in various different places. There's one there, there's probably one here as well, of support. So are we off on support here? I think it's possible, and I'm going to be looking at that. What I don't like is it's got the 50 and 200 right over. I do like the 3.8% dividend. And you could go down the list. Apache is another one that looks like it's ready to run off of support as well. So if you want to know what's moving the best, you go into industries, you look at 2-day force. Let's look at integrated oils, right? Chevron. These things have moved up a lot, but here you are about to take out the 50 with a kahuna, a mobile breakout, great earnings per share growth compared to PE, and a 3.2% dividend. You look at Exxon, 3.3% dividend. Petrobras is a little tougher for me to play. When you see that dividend, you have to get nervous. Oil, gas, services. So is there a reason why I'm bullish on energy here? The top three groups are energy. Schlumberger, Halliburton, things that pull back to support and are breaking out. 9 Energy, one of the strongest stocks in the market right now. Let's just look at, it's up 56% in the last 21 days. That's probably telling me it's a little bit rich out there. It's 222% above the 200. I would not be buying it here. It is clearly too expensive, and it's had too fast of a run. But is it too expensive? It's under major demand. Look at the growth rates, and it's a turnaround play just making profitability. So if you look at 37 and 48, 70, 85 cents, if you double that, you get $1.70. So it's trading less than a PE of 10. So maybe with this growth rate, it's not expensive. I just get nervous when I see things move that fast. And when you're 200% or more above the 200-day moving average, that's the high jump of all high jumps, and you expect it to contract. But you want to find some good stocks, look into the sector. Look at Tidewater, another one, kind of a cup, a handle, and a breakout, mobile breakout from a squeeze, kahuna. Now this one's not showing any earnings. When I see this and I don't see any earnings, I might go jump into a different program like MarketSmith. And let's just pull up Tidewater. And you can see I was looking at a different energy stock. So if we TW, obviously it wasn't called TW, Jeffrey. So let's just look at that chart again real quick. It is TDW, okay. So pull up Tidewater, and you can see it's in a pattern recognition, a cup and a handle, potential breakout on the weekly. If I look at the daily, it's at a good point there. So 2022 was a stub your toe year, although it had a number of negative years often. But look at the earnings into 2023. That's why this stock is humming. So that might be something to consider. So I do like looking at MarketSmith, especially for forward-looking earnings estimates. So that's Tidewater. If I right-click back midstream, so it's 4 energies in a row, change to group. So these are transmission or pipeline companies. And when I see these, I see dividends, 5.1% dividend on WMB. This is a stock since the beginning of the year is up 28%. So it's done well in a bad market, and looks like it's ready to go again. The other one that's above the index is Kinder Morgan, which pays 6.1. I don't think a big growth and excitement here. I think a steady eddies and dividends. Then look at the next group down is coal. Now everything is trading below the index. I usually pass it, but take a look at this guy, which is probably not enough volume for me to buy, and I think you'd have to be very careful. But here's a small stock, 200,000 shares a day, and it's breaking out to all-time highs. Now, unlike that 9 services, it's only 82% above its 200, not 220%. Then just looking at the list, and I've looked at enough of these, you can see some of the other things that are leading right now. On the telephone carriers, you look at something like AT&T, and it's hard to really love AT&T. It's a competitive marketplace. Sitting right below support, and I really like it to get above this chandelier stop right here, but it pays a 7.4% dividend. Now, when you look at long term, let's just look at a monthly chart. Hard to get excited, and can the dividend on something like this make up for the falling chart? That's up to you. I don't think so. A couple of other things about HGSI that's sitting on your desktop that you want to make sure you look at. And I really like this here, which is the top 50. So what this thing here is smart groups. A number of folks, including myself, not user groups, where's a smart group? Right here, have contributed scans to the program. Now, you can only have John's if you subscribe to John's stuff, which is a paid service. But under each of our names here are a number of our favorite scans. Some of these are bullish, some of these are bearish. But if you take all the stocks found by the scans, the hypothesis was if you're bullish, the stocks that show up the most in the most number of bullish scans are the ones you want to look at. So every time you update the program, the top 50 are going to show you the stocks that are in the top 50 by the program. Well, here's your APA, BP, I mentioned Cal-Maine, Chevron, there's a coal stock, here's a transmission stock. So if you have minimal time, sometimes what I'll do when I have minimal time is I'll just open up this group. I'll just stick on and I'll just go through these one at a time. Now think about this. Number 1, Exxon, we already saw. Number 2, this is, I didn't do it. You have to, sometimes you got to double click to get the right order. There's Halliburton, there's APA. So one way of finding the best stocks in the market is just to go to this every night. And I do that, and I'll continue to do that because to me it's just a great way of finding leading stocks. All right. Now, I spend my weekend building lists. And some people probably think I'm crazy, but those lists populate my programs. And let's go into wealth charts. Before I do that, this is Christmas morning from my porch, back porch, or lanai, or portal, whatever they call it in Santa Fe, when I woke up this morning. I mean, this was no filters, taken with my iPhone. And to be honest, it doesn't even do justice to how pretty it was. But this is where I have my mountain home in Santa Fe. And as you could see, there's just lots of open territory from my backyard. All right, let's pull up wealth charts. Now, wealth charts is really a complete program. And there are certain advantages of wealth charts over TradeStation, over Thinkorswim, over HDSI, over the VectorVest, the TC2000s of the world. And one of the biggest advantages, frankly, is Rob Hoffman, in that he is constantly putting out videos of how he uses the program, constantly updating the program, making it better. And one of the strengths is you don't have to do any daily updates. They're all done for you. It can use outside data sources beyond the ones that they include. I've hooked mine up to Tastyworks as well as the regular feed. And it's got built in a lot of the tools that I like to use. Now, from a top-down guy, I always start with the indices. And I like to look at the 5-minute chart to just give me a sense. And I usually use the spiders of what the market did. And if you want to find the beginning of the day, look for the big volume because that's the end of yesterday. So you can see the market actually opened on Friday, shot higher, came back, and that's bearish, and it traded down for a while, and then it moved up, and just traded sideways the rest of the day. Not a lot of volume at the close, not a big surprise. It's a holiday. So from the open, from the prior close, this definitely was an up day. So, because a lot of times you'll see a gap and crap, or crap and then move up the rest of the day. This is one where it stuttered at the beginning, and then probably because of the minuscule volume on the day, just went sideways the rest of the day. So you could see here the spider, and let's blow this one up as well. Remember that trend line that I drew on HGSI? Trend line's everything right now to me. And there you are back to April. Let's keep going further. And there you are to the high of the market on January 4th. We're about to lap that. Notice that every rally, the rally in March, the rally in August, the rally in December rather, all have struggled at this line. Now we did have a number of false breakouts here, which to me are actually bearish. And this line did not go from resistance to support. Certainly would have hoped so. When I look at this, all my bongos are in a sell signal, no surprise, low volume day on Friday. We have broken below short-term support, which was that 50, and failed the 50 on a retest. Now, could we get ahead? Yeah, this is going to be a weird week because of the low volume. But under normal circumstances, I'd be looking for a retest here, which was the June lows. If the June lows don't hold, then you got to think about the October lows. And then this line here is the January 2020 highs before the market rolled over. So not a bullish picture, although it was up 0.5% on Friday. And I am looking for some distortion this week from the low volume. Don't need to go as deep into the Qs. It looks the same, except it's already broken below the June lows. It failed at its trend line each of these times as well. I could extend it all the way up here to the beginning of the year. I just didn't. We look at the diamond, some new, less than good news on the diamond, in that the diamond's same trend line. Here we are going back to April. Could have taken it back to February. The diamonds actually had a very strong breakout and retest. So resistance turned into support. But now it's back below, and unless it gets above that very quickly, one has to be looking at that bearishly. Of the three so far, this is the strongest, just below that trend line resistance. The Russell also had false breakouts and now has pulled back to its June lows. The VIX, someone gave me a different ticker. Let me see if I can quickly find it. Well, of course I can't find it, but the point is that the VIX really isn't moving higher. And I can go back into, for example, TradeStation, where I've got the futures up. Let me just look over here. And you could see on a daily chart, even the VIX futures really are not doing much. So if this market was going to fall, wouldn't you expect the VIX futures to do something? I guess they're probably ready to, especially 20, but it hasn't yet. So that's interesting. That's sort of counter to what you might expect. But as my good buddy, may rest in peace, George Lee used to say, when the VIX is low, look out below. Well, the VIX is low, so I guess we should be looking out below. The dollar in the next little graph. The dollar in the next little graph is going sideways here, as you could see, as well, has broken below the 200, below the 50. And that's really been supporting the market. Commodities, if the dollar's weak, then gold should be ready to break out. It's struggling here at the 200, but I'm looking for gold to follow silver. Silver has broken out. Energy, it's interesting, energy stocks look strong, and oil's way off the high. There's a number of people calling for oil to go higher. We'll see. Natural gas has been manipulated this year. Crazy. You want to see a crazy play? For a while, I was actually playing Boyle, which is a 3x bullish um, ETF for natural gas, and this had to be the most volatile thing. Why are you doing that? Did I lose internet? So here is Boyle. Let's put Boyle on a weekly chart. Remember I talked about the volatility on this thing. There's too much time. There you go. From 140 in June to 21 in December. My friend John Person always used to talk to me about how volatile natural gas futures are. These things are crazy, and they're manipulated with what's going on in Ukraine. 10-year continues to creep higher. We showed you that earlier. Now, my market timing, simple. You got to be priced above the 30 WMA and a weekly bongo green. You could see Qs, spiders, and Russell have turned into a sell signal. That's new. The Dow still above the WMA and still green is still a buy. 3-1 to the downside. That is not a bullish feeling, in my opinion. Market theme, markets are tough, so you expect it to be up here, which is large caps and value and control, which sounds to me and feels a lot like a defensive posture. Materials doing well, communications not, energy's coming back, financials trying to come back. Look how strong industrials are. Technology has fallen off, staples are strong. Healthcare gave up some, but still leading, one-day weakness. Look at discretionary, the worst place to be right now in this market. Utilities have come up as we expected, along with staples, and real estate really struggling. So since I am mixed this week at best, let's just take a look at both some things to the long side and short side. My guess is the markets go higher. And if you look at the markets in mid-January, they're going to be lower than they are today. So if that's the case, short-term only and be careful. So this here is LFG. This is an energy play, but it looks like a takeout. And all I've done is I've ranked. I took off all the filters except 5 and 500,000 shares, at least one bullish dot, no bearish dots, nothing else is checked. So I'm looking just to see who's got bullish momentum. Helix Energy, this is one I like. Flag, pullback, and a breakout. Now, Ian used to teach us you'd get 75% or so. So you had about $3, $2 from here. Should get you up into this 850 range. Helix Energy looks good. You had a high volume breakout with momentum coming out of a squeeze, and relative strength in OBV looks strong, which is the pattern I look like for. Aflac, very similar, big flag pull, flag, breakout. On breakout with momentum, relative strength in OBV look good. AM, this is one of those pipeline midstream companies. So you don't expect these to be as runaway, but here you got momentum in a breakout, not from a squeeze. That's an EMS signal, relative strength in OBV picking up. So you can actually find stocks that look pretty good. Burlington Stores, big run up, sideways move, looks like it's running again. And notice what I'm looking for. I'm looking for stocks with upward momentum, with at least 1 or 2 bullish dots. The 4 dots include momentum, breakout, then volume, and then gap. Squeeze in yellow, PSAR reversal. Daily and weekly bongos are green, and relative strength in OBV turning up from their moving average. CBOE looked interesting this week. The challenge with that is it's really in a line of congestion, and I probably would want to see something breaking out cleaner. We looked at Chevron and some of the energy plays. Again, a nice pullback. Give me some momentum and a take out of that 50, and that might be interesting. So there's a lot of things that look interesting. LBRT was another oil services company that, again, it's got to clear the 50 to get interesting. And then some of the big guys like Halliburton. Looks like they're ready to run as well. So there are some things to the upside that look interesting. It's kind of funny. It's the same stocks that we saw when we looked at HDSI, which is exactly what you'd expect and what you'd want to see. Bear scanner. Let's go into the weekend. Not a lot of things made my list as far as having a lot of dots to the downside. So there really wasn't a lot to the bear side of showing fresh new signals. And that's what I'm getting from the CAT scanner. Now, doesn't mean there's not bearish positions out there. In my watch list, I tried to find stocks. I'm not saying I'm going to short them, but were bearish looking patterns. Why would I do that? Because if the market rolls over, where am I going to go fishing? AXNX. All right, this is a stock that clearly, if you look at the weekly, looks like it's rolled over after a big run up. It's got a defense here at the 50. Now on the daily, it broke below the 200. Relative strength and OBV are coming up. Would I short it now? No, I wouldn't short it now. But what am I looking for? And I just build a list here so I could see if they start moving. That tells me something. I like to see this thing run down, come back up to where that 200 is, and fail, and then I can short it right here. That, to me, is the type of short I want to take. We'll see if that does it. I'll leave that on the screen. American Express. Now, probably more likely interested in buying this than shorting it, although I'm not interested in buying it at all, because it's clearly at a position that you'd expect it to reverse. Okay. But again, I'd rather see it pull back into the 50 and give me a reversal there. Dexicom, breaking down below the 50. All right. Am I ready to short it today? No. It's at a place you expect it to bounce. But if it fails, comes back and fails a retest. And you can see that throughout this list, stocks that seem to be rolling over. And again, to me, it's a screening list, because if some of these start to fail, then my expectation is the market is going down. Same thing on a buy watch list, where I have a list of stocks, and a pretty big list that I put together that look interesting. Now, a lot of these stocks you already saw. You saw APA. And I will probably pick a couple of these to play this week and build my trading plan around them. But APA pull back to the 50 and breaking out here. AGR, Avangrid, I don't know what this company does, but it showed up on a bunch of my scans. It's got a new wealth signal. It's got some momentum, strong relative strength in OBV, but I don't love things that are trading below their 200. BTU on the coal play is pulled back to support. Seems to be wanting to move. It's not moving yet. United Healthcare is one that you just hate to love them, because they do a lot of choppy, and they're now sitting down on the 200, which has been, over time, a really good time to buy this stock. Okay? Look at this thing over time. How many of your stocks, let's just throw a monthly, how many of your stocks look like this over the last 10 years? Not that many. So as much as people don't like insurance companies, they make a lot of money, which might be why they don't like them. The contra ETFs are another way to play this market if and when it rolls over, but you don't want to be buying them until the market rolls over, or you'll get hurt. So let's summarize my thoughts. First of all, Merry Christmas, Happy Hanukkah, hope you have a Happy New Year. I am not planning on doing a video next week, okay? I think this market is in a tenuous position. And what makes it so tenuous is when I look at the market ETFs on a daily chart, and we are clearly short-term oversold and ready to bounce. But when I look at the weekly, we're overbought and ready to fall. Longer term, the weekly chart's going to win. Short term, you may have a few days, and with the crazy low volume of Christmas week, you may get a lot of things happening that are surprises. I hope you have an awesome holiday. Be safe. We'll see you next year.